Hello friends, welcome back to Finideas. Today we have an important and timely topic to discuss. Risk management in investment. As the financial markets are becoming increasingly complex, understanding how to manage risks while investing is crucial for achieving your financial goals. In this video, we'll delve into key principles of risk management and provide you with valuable strategies to safeguard your investments. So let's jump right in. Before we begin to understand various types of risk, let's understand what the risk is. In general understanding, risk is a maximum loss we can have in our investment. But in investment decisions, risk have a different definition. It defined as the possibility that what is actually earned as return could be different from what is expected to be earned. For example, we have invested 100 rupees with the expectation of the returns of 20 rupees in 1 year. But at the end of the tenure, we got returns of rupees 15. Here, though we have the gain of 15 rupees, but we still got the risk of rupees 5. This 5 rupee is the amount which earned less than our expectation. Friends, this was a simple example. Now let's understand various types of risk in our investment decisions so that you can take more accurate decisions in your investment journey. So now let us understand investment risks. First, market risk. This risk arises from changes in the overall market conditions and affects all investments such as economic downturns, geopolitical events, and interest rate fluctuations. Risk of the loss of value is an investment because of the adverse price movements in the market. Market risk affects those investments where transactions happen at the current applicable prices. Friends, various investment instruments having market risks are equity, mutual fund, bonds, gold, real estate, etc. The above instruments price is depending on various factors like demand and supply, geopolitical event, interest rates, etc. On the other hand, instruments like fixed deposits and small savings schemes does not carry the market risk because they are not marketable securities, means they are not available for trading on stock exchange or any other platform. They are solely sold by banks and post offices. Hence, they do not have the market risk. As they are low risk product, they are also having small returns value. In small savings scheme, government is offering around 7 to 8%. Banks are offering fixed deposits. You can pause the video to check this table showing recent interest rates offering by various banks in fixed deposit. This interest rate is between 3% to 7% depending on the tenure. Comment down below with hashtag FD rates and let us know how much interest rate your bank is offering. Now let's move forward. The second type of risk associated with investment decisions. Specific risk, which is also known as company risk or business risk. It pertains to individual company's performance, including financial troubles or management issue. Some of the key reasons behind the specific risk are increasing the cost of raw materials, increasing the business expense, introduction or positioning of competent products, increasing the marketing or distribution cost. Comment down below with hashtag business risk and let us know if you are missing out something from this list. The biggest solution to control this risk is to diverse our portfolio. If we have diverse portfolio, the impact of the business risk in a particular company will not take much impact on the whole fund. Friends, the next risk is liquidity risk. When an investment cannot be easily converted to cash without significant loss due to the lack of buyers or sellers, it's exposed to liquidity risk. For example, Investors may not be able to sell their investment when desired. It has to be sold below its intrinsic value. There are high costs to carrying out transaction. We generally find liquidity risk in properties, shares with low volume in trading, and securities with lock-in periods. Now, the fourth type of risk is credit risk, also known as default risk. This risk arises from potential default of a borrower or a issuer, most common in bonds, debentures, and loans. For example, you have invested in XYZ Limited's debentures. Initially, the company is paying interest on regular basis, but after 2 years, it stopped paying interest as well as they are not able to return our principal amount. Here we got the credit risk from the XYZ Limited because it got defaulted. To avoid such risk, you have to invest after checking the rating of the fund or fundamentals of the company. You can also take hedging or say protection if available. Now friends, we all are aware about our fifth risk, the inflation risk. Inflation can erode the purchasing power of money, affecting the real returns on investments. For example, my grandfather was having 10 lakh rupees in 1970s. He had the power to buy 10 acre of land. And if I own the same 10 lakh rupees in 2023, I can't even buy 1 acre of land. This is called inflation, where the purchasing power of the same 10 lakh rupees have declined after few years. To handle this inflation risk, we have to invest in securities, asset classes that can beat the inflation. Some kind of these assets are index, gold, real estate, commodities, and balance fund, 40-60 ratio, equity depth ratio. Now, what is the importance of risk management? Let us identify various risks and let's discuss why risk management is vital in investments. First, preservation of capital. Effective risk management strategies help protect your initial investments from significant losses, providing stability to your portfolio. Second, consistent returns. By managing risk, investors can strive for more consistent returns, minimizing extreme fluctuation in their portfolio's value. Third, psychological benefits. Knowing that you have risk management plan in place can reduce stress and anxiety related to investing. Now, strategies for risk management. Let's dive into some practical risks management strategies that you can implement to safeguard your investments. First, diversification. Diversifying your portfolio across various asset classes, industries, and geographical regions can help reduce the impact of specific risks. As the old saying goes, don't put all your eggs in one basket. Holds true here. Second, asset allocation. Based on your financial goals, risk tolerance, and time horizon, allocate your investments into various asset classes such as stocks, bonds, real estate, and cash. Third, stop loss orders. For individual stocks, considering setting stop loss orders to automatically sell a position if it reaches a predetermined price, limiting potential losses. Fourth, risk-adjusted returns. Evaluate your investments not solely based on their returns but also on their risk-adjusted returns. This means assessing how much risk you took to achieve a certain level of return. Fifth, regular reviews. Monitor your portfolio regularly and make adjustments as needed to stay aligned with your financial goal and risk tolerance. Let us understand some common mistakes to avoid. First, emotional decision making. Avoid making investments decisions based on fear or greed, as emotions can cloud rational judgment. Second, ignoring diversification. Failing to diversify your investments can expose you to unnecessary risk. Don't consider all your funds in a single investment or sector. Third, chasing high returns. Be cautious of investments promising high returns without considering the associated risk thoroughly. And there you have it, folks. Risk management in investment is critical aspect of successful wealth building. By understanding different types of risk, implementing prudent strategies and avoiding common pitfalls, you can navigate the financial market with greater confidence. Remember to stay informed, continuously educate yourself about investment trends, and always consult with a financial advisor to tailor your risk management approach to your unique situation. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more insightful content. Until next time, happy investing.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.